As per Warren Buffett, there are three categories of investments. The first of those categories are anything denominated in a currency. It can be bonds, deposits in a bank, money market fund, or cash in your pocket. These are low risk investments and offers a fixed annual interest payment. The benefit of this category is that you know in advance how much you are going to make on your investment, that is your ROI. The disadvantage, however, is that of inflation. If inflation is higher than the interest you earn, then you effectively lose money. So, on one hand, you have surety of income, on the other, risk of inflation eating away your income. So, now the second category are the items that you buy which don't produce anything, but you hope someone will pay you more for it later on. So, the classic example of this category, as Warren Buffett says, is gold. Warren Buffett often says that if you can accumulate all the gold mined on the earth so far and store all of it in a big room for a few years, it will stay just the same amount, that is, it won't grow any bigger. Therefore, we aren't going to have more gold, we are just hoping that somebody buy it from us for more money on a later date. The same can be said about modern day pseudo wonder cryptocurrencies like Bitcoin. This investment category is often explained by the greater fool theory. I will explain this greater fool theory in more detail in a separate video later on and link it at the end of this video. But for now, in short, the premise of this theory is based on speculation, that you buy a speculative asset at an overinflated price and expect somebody else to come and buy it from you at an even higher price. This is a very high risk, high reward investment strategy, and value investors like Warren Buffett stay away from this kind of speculative investments. Now, the third category of investment are assets. So, what are assets? Assets are resources which are owned by company or an individual and that generates money or income. Some examples of assets owned by company are cash, inventory, their machine or property, plant and equipment, the buildings they own, the copyrights they have. All of these are examples of assets on a company's balance sheet. So according to Warren Buffett, assets are valued based on what it produces or what it will deliver. For example, you buy a farm because you expect a certain amount of corn or soybeans or cotton or whatever it may be to come your way every year. You decide how much you pay based on how much you think the asset itself will deliver over time. The same goes for stocks, which are nothing but companies divided into many parts. You can either buy the whole company if you have enough money for that, or buy a part of it through stock market. These companies produce something every year or provide a service to its customers, just like a farm produces corn or soybeans, which are then sold in the market and earn money. Companies, in the same way, sell their products, earn money, and pay the profit as dividends to its shareholders. This is how you make money by owning assets, as per Warren Buffett. One of his famous examples is See's Candy, which does business every year, makes a profit, and pays all of it as dividend to Berkshire Hathway, which is Warren Buffett's company. Companies can also retain a part of their profit to invest for the future growth. For example, a semiconductor manufacturing company can decide to retain its profits for the year for capex, for capital expenditure, to open another manufacturing plant next year. This will enable it to produce more chips and earn a higher profit for future years, which it can then distribute as dividends to its shareholders, who are the actual owners of the company. This doesn't happen in second category, which we saw earlier. Over time, as a company increases its assets and profits, its market value will also increase in the same proportion. Now take a look at how Warren Buffett explains this at the Berkshire Hathway annual general meeting.
There are three major categories of investment. The first category is anything denominated in a currency. It can be bonds, it can be deposits in a bank, it can be a money market fund, it can be cash in your pocket. And the second category of investments regard items that you buy that don't produce anything, but that you hope someone will pay you more for later on. And the classic case of that is gold. The third category of asset is something that you value based on its what it will produce, what it will deliver. You buy a farm because you expect a certain amount of corn or soybeans or cotton or whatever it may be to come your way every year. And you decide how much you pay based on how much you think the asset itself will deliver over time.
So what do you think about Warren's investment philosophy? Let me know in the comments. Meanwhile, this is all for this video. Thanks for watching, and until next time, see ya.